Hello, I'm Deborah Trow, and this is the Elevation Market Update for November of 2023. Today, I am pleased to have Brett Floyd of Delaware Funds with me, and we'll be in conversation about the financial markets. Brett has worked with Delaware for 12 years, and he's the regional director for New Mexico. And for the past 9 years, he's been based in Dallas, Texas. So welcome, Brett. We're glad to have you.
Thanks, Deborah. It's great to be here.
Okay. And here we are at the end of 2022, and the markets have been in a downturn all year. Since my last presentation, we've had the election happening at the beginning of November. Let's start out by first having you give us an overview of where you see we are with markets at this point in the year.
Sure, be happy to. So where we see markets right now, we've gone under a lot of stress in 60-40 portfolios. As a matter of fact, this is one of the worst years in the past 70 years for a 60-40 balanced portfolio. Both stocks and bonds throughout the year have experienced a lot of negative return and a lot of volatility. That is mainly because of interest rate hikes, and the Fed Chair Jerome Powell, in order to combat inflation, which was at an all-time high this year, around 9%, needed to raise interest rates much higher than where they were at zero. The Fed funds rate was at zero. Now it's around 3.75, and the market is already priced in around 85 to 90% of those hikes. So we don't have very much hiking left to go. I think the target of the Fed funds rate is going to be around 5%. So that's about a 1.25% left. Now, today was an interesting day. He said that he's going to signal actually slowing of rate hikes starting in December. What that really means is he's starting to see some of the effects of the economy slow down to the point where we don't have to be as aggressive in raising rates and raising the cost of borrowing for everybody, including corporations and even you and me, like credit card debt, borrowing for a car, getting a personal loan, getting a home equity line. I think we're at the top or near the top of those interest rates. So I think a lot of the damage has been done, so to speak. And I think going forward, you really just have to look at where inflation is coming down and how fast it comes down. Now, we got a good CPI, or Consumer Price Index, reading last month, which was down to 7.7%. That needs to come down a heck of a lot more. And we do expect that to come back down quite a bit here, I think, in the next 6 to 9 months. That being said, there's still a lot of work to be done. And once we get to that 5% rate and the Fed funds rate, I think that Jerome Powell and the rest of the Federal Reserve is going to keep rates at that level until he sees he and they and she and everybody in the Federal Reserve Board want to see the interest rate of the core personal consumption expenditures index number come down to around 2%. Right now, that's around 4.7%. So inflation needs to come down a heck of a lot more in order for them to stop or to go back the opposite direction and lower rates. I think we get to a certain point in rates and we kind of stay there for a long time until inflation kind of subsides. As far as the election's concerned, 80% of the time after the elections, and we just had them recently, 80% of the time in the next 9 to 12 months, we've had a increase of around 8 to 9% return. And that is kind of par for the course. So if you're playing numbers, things look to be pretty good from a return perspective going forward.
Well, thank you for giving us that information, Brett. But you know, the big thing that's on people's minds, and you haven't mentioned the word yet, but I will, is what about recession? Is this happening? Are we already in it? What does Delaware Funds think about that?
Yeah, so the recession is the word right now. And I think what you have to look at right now is a few things. What determines a recession? And so the Fed's looking at the job numbers, so to speak. They're also looking at manufacturing numbers. They're looking at service numbers. Manufacturing has started to roll over a little bit. You started to see a little bit of deflation there. Services remain pretty high. Owner's equivalent rent stays high. And the job openings are, albeit they've came down a little bit, there's still a lot of jobs out there. And so What the Fed wants to do is to lower all those numbers, and they don't want to lower them too much to the point where we get into a major recession. And so that's the balancing act that we're in right now. So the magic word recession, 100% of the time, the last 8 to 9 times the Fed has tried to so-called thread the needle or to put a stop to growth to the economy to the point where inflation comes down, they've never been able to do that before. They've never had a soft landing before. And so do we have a recession? In our opinion, yes, we do. Now, to what degree do we have that recession? That's the question that we have to talk about. And I think really, we don't really think that there's going to be a huge hard landing or a hard recession. And why is that? I think it's because a lot of people still have a lot of money in their bank accounts, albeit it's dwindling a little bit, but there's money in the accounts. There's still money in their checking accounts. There's still a little bit of equity, if not a lot of equity in their homes. And there's a lot of M2 money supply still floating around there. So yes, there's a lag effect of when you raise rates, it's about 4 to 6 months afterwards, you start to see tightening conditions and a little bit more of your tightening your belt. We're starting to see that now. I think you'll continue to see that in the next 4 to 6 months. And I think you will see a recessionary environment, but to what degree, we think it might be not as hard as other people think, because I think the Fed is looking at it and they're saying there's still a lot of money around. We want the inflation numbers to go down, but we don't want to cause a hard landing. We think there's a recession. We don't think it's a catastrophic event at this point.
And if we are going into recession or even in it already, how long typically does that last?
Typically, recessions last around 6 to 12 months, depending on how severe. We are in the camp of thinking that because interest rates are going to remain high, a recessionary environment wouldn't last too long in this environment, mainly because once they start to see the whites of the eyes of a recession, they'll make adjustments as need be. And keep in mind that the Fed funds rate will be at 5%. So if they see a major recession coming around, they can always lower rates back down and lower the cost of borrowing for both corporations and people to ease the restrictions going forward. The key is going to be, where is inflation at that point? If inflation remains sticky and it's above the 2% number, what they will do is they will unfortunately have to keep a restrictive policy on interest rates. And what that will mean is the recession could last a little longer. But the degree and the depth of the recession, how hard it will hurt, we don't see a deep recession. We see maybe a moderating soft recession, but maybe lasting a little longer until the inflation numbers come down to where they want it to be.
Yeah. So it sounds like the inflation is still the key thing that has to be put under control.
Absolutely, Deborah.
Yeah.
Absolutely.
Yeah. So from what you're talking about, though, it sounds like hopefully this is not the 1970s happening again.
Yeah, it's a good thing you brought that up. I think what Fed Chairman Powell and the rest of the Fed board directors look at is they look at past recessionary environments. And the most consistent, the most like environment that we've seen in the past that kind of mirrors today is the late 70s. And what they don't want to do is have inflation last too long. In the late 70s, what happened with Paul Volcker was he would have raised rates similar to what we're doing right now. But then when they saw inflation go down, he would stop raising rates and he would look around. But the economy was still strong. So once they stopped raising rates, inflation would go right back up. And then he'd have to raise rates again. And then he'd pause. And then rates would have to go back up again because inflation would go back up. And this process repeated itself all throughout the late 70s until 1980, where he had to bring the Fed funds rate almost over 17.5% to 18%. Now, we don't think that's going to be the case now, especially because there's different calculations in how you calculate the Fed funds rate and inflation in particular. But I don't think they're going to want to make the same mistake twice and let inflation last 4 or 5 years. I think the chairman and the rest of the Federal Reserve want to lower inflation, make sure it stays down low and it stays that way, because the lower class cannot afford to pay $10+ for milk and bread for 4 straight years. It's too much strain on the lower class, and then it'll eventually bleed into the middle and upper class as well eventually. So we don't want inflation to be sticky for a long period of time. I think they're going to try to just go ahead and make sure when it goes low, stays low. And so that's what they're going to do.
Mhm. And they do look back at these prior situations and they do learn from it, don't they? So that they don't quite do the same approach with this recession possibly approaching versus 2008 versus the 70s.
Absolutely. They do. They're always looking at historical patterns. Mark Twain said history doesn't repeat itself, but it often rhymes.
Yes. So given all of these factors, how is Delaware managing the mutual funds that they have for our clients? And how are they making decisions on what companies to invest in?
It's a great question. Thank you, Deborah. Right now, in all of our portfolios in the Delaware Ivy funds, we are specifically looking for companies to have a sustainable amount of cash flow, a good amount of free cash flow. They're very defensively postured. They've got a great cash position. They've got a great competitive advantage amongst their peers. They have a moat around their business. So not a lot of competitors can come in and take their market share. I think that's very important in today's environment, especially going over the next 6 to 12 months as we potentially see this recession around the corner. You want companies that are going to be very high quality companies that are generating a lot of free cash flow. They're not over leveraged. They don't have a lot of excess debt, and they have that competitive advantage with that moat around their business. And so all across our portfolios at Delaware Ivy, we're making sure that those type of names are included in our portfolios and remaining defensively postured.
Mm-hmm. And some of our clients might not realize, but Delaware actually handles the Ivy investments now that many of our people have had in their portfolios for a number of years. Can you speak towards that a little bit? Absolutely.
So Delaware Macquarie, we decided to look for opportunities about a year and a couple months ago. And we found that Ivy was a very, very good company that was able to be acquired by us. And so we acquired them for $1.7 billion. We've since then integrated the Ivy funds with the Delaware lineup, and we have a very, very robust platform now with both Delaware and Ivy funds going forward. The AUM in that acquisition made us about 17th in the world in AUM. So we're a top 20 global player.
Mm-hmm. And AUM is assets under management, if anyone is wondering.
Yes, I should have said that.
Yeah, so, and I know that when we look at our portfolios, making the analysis, we can see those funds are continuing to do very well under current conditions. So can you give us a couple of specific examples about companies that are doing a good job that Delaware considers to be a good investment in your funds?
Absolutely. So for example, for our large cap growth portfolio, the Delaware Ivy large cap growth, a good example is a company like Motorola. Motorola has around 13,000 land mobile radio networks. We have about 5 million video cameras deployed, over 3,500 command centers using MSI software. Basically what that is the digitalization of public safety. So back in the day, you just knew Motorola as phones. Well, they don't just have phones now, they diversified their business and they have a lot of revenue streams generating a lot of free cash flow going forward. For example, 50% of the 2021 revenue came from software, video, and services versus only 20% in 2015. So they have an exceptional amount of free cash flow on the balance sheet, and their margins are extremely strong going forward. That's a great example of what's in our Delaware Ivy large cap growth portfolio. On the Delaware value side of things, a company like Dow DuPont, very large corporation, been around for a very, very long time. Over the past decade, they've diversified their business model. Before it was, Dow DuPont paint, et cetera. Now they're in the automotive industry, the construction industry, they're in semiconductors and water solutions. Again, this is a company that has a lot of free cash flow on their balance sheet. They've since refinanced a lot of their debt at a lower rate back in the day, about 2 years ago. And so their cash position on having to pay down that debt is a lot less than other companies would be. So they've got multiple revenue streams in multiple different areas. They're very diversified. They've already refinanced their debt at lower rates before these interest rates went up. They have a competitive advantage amongst their peers. I know you've heard that before from me. And again, their leverage position, they've improved it dramatically. So those are just a couple ideas of companies that are in our portfolios that are safe, large, diversified, secured, not over levered, and have a lot of cash in the balance sheet. And I think that defensive posture, as well as being market leaders in your certain industry, those are great positions to be in going forward in this tumultuous environment.
Yeah, and that makes complete sense. It's just like we recommend ourselves, isn't it? That being diversified, not having all the eggs in one basket, and having cash on hand. That makes sense every time when you're in a tricky spot there. So something else that our clients have started to ask about is cryptocurrency. We recently saw, of course, the demise of the company called FTX. And so I'm being asked, do you have crypto in my investments? Because I don't want to have that. So this is the question for you. Is there cryptocurrency in the Delaware funds? And tell us about Delaware's position on that.
Yes, no, we do not have crypto investments in any of our funds. It's not a regulated investment, and it's also not based on solid fundamentals. I think FTX has demonstrated the risk of following the crowd because it sounds good. I think when money is free, so to speak, when the cost of borrowing is zero back in the day, I think a lot of people were investing in things that weren't regulated, that sounded really good, and everybody started talking about Bitcoin and FTX and all the other cryptos. And I think because of the non-regulation and really just there's a lack of transparency there, we're not even touching that area for the time being. So there's absolutely no crypto in our portfolios. I think it's more of a crowd following thing at this point.
Yeah, and it definitely sounds like something that it's still in its infancy as far as how does it even fit within our economy and as an actual investment, doesn't it?
Totally agree with you, Deborah. I think maybe years down the road when all the countries and all the banks can finally put their arms around this and potentially regulate it so it's safe for your clients, I think then you can start to talk about it. But if something's unregulated and it's not safe for any of your clients or anybody's clients for that matter, it doesn't belong in the Delaware Ivy lineup at this point.
Yeah, and I think a lot of our clients, they don't even realize how much regulation there is, say, around the position of portfolio managers and analysts, how much education they have compared to an individual that just comes along with an idea and starts to persuade people to put money behind that. So it will be interesting to see what happens in that particular case, although, of course, sad that people have lost money doing that. So any last comments here, Brett? We're moving along with our time.
Well, no, I just think you should keep a long-term perspective in anything that you're looking at, especially with your investment portfolio. And if you have any questions whatsoever, worries or concerns, just please reach out to Deborah or the team for any questions. And thank you so much for having me.
Well, thank you, Brett. And this is really great information. And we are always looking to help our clients to just cut through the noise of so much information that's out there. And that's it for today. Hope that our viewers, that you find this helpful. If you have a question that we didn't answer or something on your mind, please feel free to call us or email us at the office, and we'll be happy to speak with you directly. Having said that, I'd like to wish you happy holidays and tell you that our next Elevation Market Update will be recorded and sent out in January to kick off the new year for 2023. Thank you. I'm Deborah Trowell at Elevation Financial Group.